Well, and he doesn't even recognize the inherent fallacy in what you just said.
Well, number one,
if it's zero, then there should be infinite money already.
Exactly. I was saying the same thing. If there's zero on some deposit, then how comes that automatically turns into infinite money circulating in the economy?
Okay. Before I get bogged down again, I'm going to play.
Base currency that's piling up back here is really nothing but a receipt or a claim check on an IOU, that bond. So it's really nothing but a supply of numbers.
Well, what's wrong with that?
The Treasury then deposits the newly created currency into the various branches of the government,
Also,
and the politicians say, hey, thanks for that. And the government does some deficit spending.
Say it again.
So just to be clear, cash money is not an IOU for a bond. The government doesn't promise you necessarily bonds at a fixed price for $1 because the interest rate can change, the prices can change. But what they do promise is the discharging of a $1 tax liability. So in that sense, a dollar is an IOU. When the government spends a dollar into existence, they promise that with $1, you'll be able to discharge $1 of tax liability.
Correct. Which is also why, again, I appreciate the MMT standpoint, is it gives a very concrete description of what the value of any given money is. Because in the classical, the neoclassical, the Austrian viewpoint, there's always this, well, today's money is based off of what yesterday's money was worth, and yesterday was based on the day before, and the day before was based on the day before, and like there's this infinite regression of like, hey, it's turtles all the way down, which, I mean, that's just nonsense. Versus when you look at the MMT version, we say, okay, what we're doing is we're creating a unit of measurement for measuring debts, and it's equal to the amount of debt we say it will extinguish.
Yeah.
Done. Right?
Yeah.
Now, the market can turn around and say, okay, well, this is what we think, everything's worth based on, how much that we have left over. But at the end of the day, the core value of whatever that currency is how much debt it can extinguish to the taxing authority that says, hey, you owe us the taxes in this decreed arbitrary unit.
Yeah.
Spending on public works, social programs, and war. The government employees, contractors, and soldiers then deposit their pay in the banks. Now, this may come as a shock to you, but when you deposit your currency with the bank, you're not actually depositing it into an account to be safely held in trust for you. Instead, you're actually loaning the bank your currency.
I think that's technically
And
true.
within certain legal limits, they can do with it pretty much anything they please. This includes gambling in the stock market and loaning it out, at a profit, of course.
That was half true.
Yeah.
They can gamble it on the stock market, I think. I don't know what regulations are associated with it, but they can't loan it out. That's not how loans work.
Neither of those two. So you will always have a claim on the money that's in your checking account. It's not, they don't siphon that money out of your checking account and put it in stocks, right? Now, the reserves, they have a reserve account where they have some flexibility on whether they keep the reserve at the Federal Reserve, or if they buy a treasury bill, or even if they buy longer term bonds. As I explained earlier, it wasn't such a good idea in 2022 if you were First Republic Bank or Silicon Valley Bank. Caused a lot of problems there. But generally speaking, he's gonna get into the fractional reserve.
Right. Okay. Let's get into it, and we can save our vitriol for that.
Yeah.
Now this is where the machine of currency creation really gets cranking, because this is where something called fractional reserve lending comes into play. Fractional reserve lending is exactly what it says. The banks are allowed to reserve only a fraction of your deposit and loan the rest out. Although reserve ratios may vary, I'm going to use a 10% reserve ratio as our example. If you deposit $100 in your account, the bank can legally take $90 of it and loan it out without telling you. The bank must hold $10 of your deposit in reserve just in case you want some of it. These reserves are called vault cash. But why does your bank account still say you have $100 if the bank has stolen $90 of it?
Stolen.
Because the bank left IOUs it created, called bank credit, in its place. Now I know this sounds crazy, but here it is in black and white from the Fed. Commercial banks create checkbook money when they grant a loan simply by adding new deposit dollars in accounts on their books in exchange for a borrower's IOU.
Not what
Yeah,
you
and
just said.
it doesn't follow that they took your deposit money in
Right.
order to do that.
Right. No, so that's accurate. So once again, this is the symptom of partially true, but not accurate.
Focusing on the wrong part. Yeah.
Yeah. So this is the fractional reserve story flips reality on its head. So he's suggesting that banks wait for a deposit and then lend out that deposit, which is actually the opposite of how it works. The bank makes a loan out of nothing, out of thin air, and then they will find the funding sources for those reserves that they will then have to transfer. Once the check's written, the recipient's bank will come to Bank A and ask them for the reserves. And where they get those reserves from, well, there's multiple options they have. They can go to the Federal Reserve directly, which is the worst, the most expensive. They can get it on the interbank lending market. They can attract savings accounts, or they can attract even better checking accounts. This is why banks oftentimes compete for your checking account money and provide incentives in order for you to put your money in their checking accounts. Like, for example, I have a safe deposit box at the bank across the street. They give me they actually
There's no fee if you keep a certain amount of checking money.
It's not across the street. It's like way over the other part of the country. But I just misspoke. But yeah, because so they'll give you incentives. They'll give you like 50% off the annual fee and you pay very little for it. So that kind of stuff they do. Because for checking account money, they don't pay you any interest. So that's the cheapest form of bank reserves they can attract. They can have clearing their way in order to be able to meet clearing demands, tax payments, and the bank withdrawals.
Nima, keep talking. I got to use the bathroom. Give me 2 minutes.
Oh boy. Okay, so
what he talked about the reserve rate. This is a good time to talk about how the reserve rate does nothing for how banks loan or don't loan.
Right. So he's suggesting that there's this mechanism where there's a deposit, what's it called? A reserve rate, let's call it, I forgot what it's exactly called, reserve ratio of 10%, right? So the bank takes $100 and now they're allowed to loan out $90. So they immediately turn around and loan out the $90. So this is like, I've learned this shit in college too, in economics undergrad classes, and even graduate classes to some extent, where there's this mathematical formula by which we can tell how much loans grow within the banking system, which is not a thing. The banks don't loan $90 of money because you just deposited $100 of money in their bank accounts. Bank loan officers don't care how much money depositors have put in the bank's checking account. They are busy looking for willing and able borrowers who are good credit risks or medium credit risks, and whatever credit risk, charge them in a risk appropriate rate in order to secure a loan, and then they will earn a revenue through the interest that they earn on that. Whatever happens on the deposit side is a separate section of the banking business that has nothing to do with what the loan officer does. So let's continue because it gets even worse, and I want to poke fun at.
Okay, and then I just want to add, I agree with everything that Nima just said that I didn't hear.
These are nothing but numbers that the banks type into their computers.
Correct.
And even though these bank credit IOU numbers are very different from base currency numbers because they only exist in computers, they are still currency. So now there is $190 in existence. Now, the reason people take out loans from the banks is to buy something. They're going to buy a house or a car or something like that. So the borrower takes the $90 that the bank loaned to him from your account, and he pays the seller of the item. But then the seller deposits that currency into his account, and his bank loans out 90% of that and leaves bank credit numbers in its place. So now there's $271 in existence. This process repeats and repeats until under a 10% reserve ratio, an initial deposit of just $100 can create up to $1,000 of bank credit, all backed by $100 of vault cash, just 10%. But as I said, reserve ratios vary wildly. On some deposits, it's 10%, on others, it's 3%, and on some forms of deposits, reserve requirements are 0. The result is that the expansion of the currency supply by the banks is far greater than even this example would lead you to believe.
Well, and he doesn't even recognize the inherent fallacy in what you just said.
Well, number one,
If it's 0, then there should be infinite money already.
exactly. I was saying the same thing. If there's 0 on some deposits, then how comes that automatically turns into infinite money circulating in the economy? Because that's not how bank loans work. Banks make loans, like I said, when they find willing and able borrowers. Now, also, what I like about this illustration here, so Dylan, have you ever gone to a bank and the bank goes, "Oh, sorry, we've already loaned out all the $90."
Right.
But to the
Right,
other,
no.
the bank 10 blocks down the street, they are still in the process of loaning out the fractional reserve money. If you run over there, you might be able to get a loan there, right? Not
No.
how this works. It's a fiction.
Yeah, and then we've discussed this in other shows as well, is that this reserve ratio is really just arbitrary nonsense.
An observation in hindsight, basically. So there happen to be reserves in the system against loans made, but that is an afterthought. That's not the beginning of the system. And like as we've pointed out many times, in Canada, there is a 0 reserve ratio, because some countries have institutionalized reserve ratios, others don't. Canada has a 0 reserve ratio. It doesn't change anything fundamentally about the system.
Yeah. And then I don't know if you mentioned it while I was using the bathroom, but they make the loans first and they turn around and find the reserves later. And the way that the system is set up, the reserves are always available.
Yes.
So the
no
limiting factor is, like you said, the ready and willing borrower. And I guess on, for example, a home or a car loan, they look at your income and say, well, we think you can afford it or not. Or if you're going to acquire a business, they say, well, okay, well, show us the financials of the business. Or are you going to start a business and say, show us a pro forma? Do we think that you're going to be able to end up paying on this loan based on how much we believe in you and your system or whatever? And they create the money out of nothing. And the fact that they turn around and use that money to generate economic prosperity. Honestly, this brings up what we've heard from Richard Werner, to bring him up again, is that when money is created for businesses, that's actually not technically inflationary, because you're increasing the goods and services with the money creation, versus if you're just making your system is making a bunch of loans on assets, whether that's stocks or houses or cars or RVs or whatever, you're throwing more and more money at a limited supply of goods. So asset lending, creating money to buy assets, is inherently inflationary, versus creating money to fund or start businesses is inherently not inflationary. I thought that was a brilliant point made by.
It's possible.
Werner.
It's an interesting theory. There's also theories that suggest that actually business lending is inflationary for different reasons, because if you lend money to a business that manufactures machinery, they employ people to build the machinery, but the machinery does not hit the consumer market. But
I guess it depends on what type of business it is. Yeah.
Yeah. So if it's investment goods, investment spending in the economy tends to have an inflationary effect, according to Randy Ray of the MMT. He's from the University of Louisiana or something. I forgot where exactly, but or Missouri, St. Louis, Missouri. Yeah. He suggests that if the sum of deficit spending plus investment spending plus current account surpluses as a percentage of GDP rises, that is inflationary. And there's because, like I said, the people who are employed in the machinery business, they still go out and buy consumer goods, but they didn't add any new consumer goods. So that could
Right.
have some inflationary effect right there. But I also think Richard Werner's theory has merit, because obviously, same situation. If you lend money for an asset and nothing new has been produced and no consumer goods have been produced, so, and even worse yet, you haven't even added any capital goods that could improve worker productivity and drop prices in the long run. So yeah, I can totally see that lending
Yeah,
for
well,
assets.
I think that was the point I wanted to make is, okay, yes, it's inflationary to invest in capital goods, but the idea is at some point it's going to be deflationary because those capital goods are going to be producing consumer goods, theoretically. Yeah. If everybody who's watching this now or recording could like, share, and subscribe it helps us out a lot.
Yeah.
I hate saying it, but it's just true.